So first of all, the first thing we have to discuss is what is a stock. A stock is a share in the ownership of a company, and this is something a lot of people don't realize. A lot of people look at a stock and they see it as a stock ticker, a blip on the screen, or a 3 or 4 letter symbol. A stock is really a share in the ownership of a company. So when you invest in stock, you're investing in that company. You're a part owner of that company. Even if it's a very small part, you own a piece of that company. And as a result, this is holdings of a portion of the company's assets as well as their liabilities. So this ownership stake is relative to the number of shares owned versus the shares outstanding. So if you have a lot of shares of that company, you are a larger owner. And if you have just a few shares of that company, you are a much smaller owner. So your ownership is relative to the number of shares you own versus the number of shares out there. But nonetheless, even if you own 1 share of a company, you own a small piece of that company. Now, a stock may offer rights to vote in company decisions depending on the share class, and we're going to discuss that in the next slide here. And that's something important too, guys. You have to understand that when you invest in a company, because you're an owner, you have to vote in company decisions. And I always encourage you guys to, take advantage of those opportunities, and you should vote in company decisions because you're part of the owner of that company. You have just as much a say as anyone. Maybe you don't have as much of a vote because you don't own as many shares as some people, but you do have a say in those company decisions. And obviously the voting power corresponds with the ownership stake. So if you have many voting shares, you have a larger say, and if you have less shares, you have a smaller say in those company decisions. It is important to consider whether or not you have voting rights as a shareholder. And I always look for a company that allows me to vote in company decisions. So just for an example of a company that did not do this, we have Snapchat, and they recently went public. So Snapchat offered Class A shares, which do not include any voting rights or any votes. So if you're a Snapchat shareholder and you own Class A shares, which are the ones that have been traded and that are on the secondary market, you have no say in those company decisions. You have to rely solely on those who have voting shares. The Class B shares get 1 vote per share, and these were reserved for the early investors as well as the executives. And then the Class C shares are held solely by the co-founders, and they get 10 votes per share, while the Class B voters got 1 vote per share. So just to put a picture on this, or just to explain this to you guys, the Snapchat co-founders hold 88.5% of the voting power, while the public shareholders hold absolutely 0% voting power. So that's not something I like to see when I'm investing. That's why I'm always looking for a stock that offers me voting rights. I know if you guys know Google, when they split shares, they offered everybody who had an existing share 1 non-voting share per share they had. So that's why you have the GOOG and then the GOOGL. One of them has voting rights, one of them does not have voting rights. So that's just another example there. But I always want to be buying shares of a stock that I have, voting rights, because I want to have a say in company decisions. I don't want the co-founders or anybody to have 88.5% voting power. That means that pretty much whatever they say goes. And I like to have more of a say in the companies that I'm part owner of. So what is the purpose? Why would a company go public? So companies offer shares to the public to raise capital through an initial public offering. So this is why a company will go out there and they will, offer shares to the public. Basically, companies can also raise money through borrowing or corporate bonds. And we're going to talk about bonds a lot in this course numerous times, but just to start off, a bond is a debt obligation, and bondholders receive interest in return for loaning the principal. A lot of people blur the lines between stocks and bonds, and we're really going to get into the difference of those two things because they are not the same thing at all. But what is important to remember is that because a bond is a debt obligation, bondholders take priority over shareholders during a bankruptcy filing. So if worst case scenario, you're invested in a company that goes bankrupt, understand that anybody who is a bondholder, they're going to get paid before the shareholders do because you're part of an owner of the company where they're just a debt obligation. So as a shareholder, you are last in line as far as the distribution of remaining assets goes. That's really nothing to be afraid of. I mean, if you're making sound investments, there's not a high risk of a company going bankrupt. I mean, if you're making high-risk investments, yeah, there's a higher risk of a company going bankrupt. So just keep that in the back of your mind, that shareholders are pretty much last in line as far as distribution goes when they go bankrupt and they're finally sorting things out.